Hey everybody, hopefully you're having a good day. My name's Andy, my channel's Finding Value. If you like making money, if you want a better understanding of the markets, real estate market, stock market, it's from an investment standpoint, from that viewpoint. Subscribe to the channel, give me a thumbs up for this content. I'm answering a question here. The question is basically, how does the real estate market go up and go down? The basic question is, what are the fundamentals? What does it look like? Describe to me the process of things going up and things going down. Now, this can be applied to any commodity. All right. I'll do another presentation getting into the nuts and bolts of the normal distribution curve and what the curves look like per, we'll call it a specific oil field or commodity. I can show you that stuff. But this one's just tied to real estate right now, but it can be applied to all other commodities. So the first thing that happens is you go through this cycle back and forth. There's 4 phases to the cycle. It's just like a commodity. You have a recession where I'll start with the hyperbubble. You have a hyperbubble or hypersupplies. That means that the supply goes way up, your inventories get filled, and price starts to decline because the supply outsupplies the demand. So that's called a hypersupply phase. You hit this hypersupply phase, it'll last for a little while. In real estate, it may last for a year or two before prices start going down. Then you start heading down after there's too much supply, and we call that the recession phase. So that's the second phase. You go into recession and prices decline. That signals the market to cut back on the supply. That cutback will happen till the supply-demand balances itself. And sometimes the pullbacks can be quite substantial. They could be 50%. They could be even more than that. It could be a 90% decline because of the overproduction in the hypersupply phase. It pulls back during the recession, and then we go into what's called a recovery phase. A recovery phase is basically where the demand and supply self-balances itself out at some price, whatever that price is. And it typically what happens on the recession to recovery phase is the price falls and goes below the high cost producers. So basically it cuts back a good portion of the supply, but not all of the supply. So you're left with the low cost producers and middle cost producers that are still producing, but all the high cost producers get, quote, crapped on. So during that recovery phase, what happens is at some point, the supply and inventories get dwindled down. So we cut off supply, demand starts to ramp back up during a recovery phase, and your inventory gets eaten up. So you're using inventory, you have some from production, you're using inventory, and eventually your inventory starts out high and it starts to decline until you eat through all of your inventory. When your inventory is gone, prices really start moving. Now, there's a twofold thing that happens with inventory. This isn't just inventory goes away and you have this nice steady increase of price. What happens is you get hoarding, you have investors that pile in, you get a whole bunch of people that see it before it happens and they start piling in. And it's like us. We're investors, me and you. We do ratios, and that ratio identifies basically where your high inventory is and where that inventory is getting eaten up, because it'll tell you that the valuations are low on a historical basis. So we're investing in the unfavorable commodities or wherever it is because the inventories are high and they're getting dwindled down. I'm looking at market conditions to see when the deficits, that's what the market balance is, where those deficits occur in the future and where the inventories are at. That's what makes me successful as an investor. So the inventory gets eaten up. We run out of inventory. A whole bunch of people typically pile in at the same time. And then you've got people who are scared. They say, holy crap, prices are starting to move. Then everybody jumps in. That's you've got a dead period, and then everybody sees it and everybody jumps in at the same time. So then prices start rocketing. Now, the price duration and how high it goes depends on how easy it is to bring production online and the cost of that production and the length or duration it takes to bring that production back online. So if you have a very difficult time replacing or increasing the supply, the longer and higher that market's going to go. Uranium is very difficult to bring online. A lot of these mines, especially copper, takes because they usually have massive mines. Sometimes that takes some time. Nickel is, I think, another one. We don't have that much in the world in terms of just a whole bunch of supply everywhere. And you have to also keep in mind from a commodities standpoint is that we have declining ore grades, and that decline in ore grades, the decline in oil, there's a whole bunch of other things that are in the background increasing the prices to produce these items or mine these items. But on the real estate market, I'm going to give you an example through real estate. I've got the housing starts right here, and what we're looking at are the new privately owned housing starts. So that just means new homes being built. And when we look at this, this is the cycle. It's the recession phase. The recovery phase is the bottom here. Then we go to an expansion phase. We go into a hypersupply phase, and then we go back into a recession phase where it comes back down, and it goes cycles back and forth. Now, the yearly demand is 1.5 million housing units. It goes across here. And anything below that 1.5, all of this area means that we underbuilt. And the reason we underbuilt in terms of new homes, the reason we didn't build new homes is because we had a hypersupply phase and we had a problem in housing where we gave a bunch of bad loans at the top of this market. All those loans went underwater. Underwater means that you owe more on the house than what the house is worth. So all those people walked away from their loans. They said, screw it, I'll just go and foreclose the house, give it back to the bank. Problem was, we had a massive amount of people that did that. And down here, this whole time, the new housing starts or new home builders were trying to compete with a buttload of foreclosures. And they couldn't. The foreclosures were way too cheap and they couldn't do anything. So they just cut back the housing builds all the way back to the lowest levels in time of history. I mean, in terms of, I say relative history. So they were underbuilt. This created an underbuilt scenario because you still have the 1.5 million demand coming every single year. We just didn't build the new homes to satisfy that demand because of all the foreclosures of the last bull market or hypersupply phase of real estate. So we underbuilt by 4 million homes. So we need to go above the 1.5, this 1.5 area. We need to go above that with an additional 4 million homes above the 1.5 yearly demand. That's how many homes we have to build. Now here is, remember I talked about inventory, and inventory needs to get eaten up before prices really start to move. So these foreclosures took time to work off in the recovery phase, and that inventory of all these new homes that were built up here, that also had to be worked off. Now we've worked it all off. It's gone, and I can show you what that looks like. So I'm just going to show you an article. It says housing inventory hits a record low, what it means for buyers. Basically, they're screwed. Because you can't get a house and the inventory's gone, which means prices are going to move. And I'm going to show you another article here. And it says 3 months supply of inventory. It's even less than that. But this is kind of what it looks like. This was a boom time right here. This was a big housing real estate boom. And then you can tell in 2005, they started creating all these loans, and these loans were starting to go bad, and they were starting to overproduce homes. You could see it in the month supply of inventory. They were starting to move up and up and up. And when you get to 10 months right here, I mean, that's a lot of inventory. That's why you've heard me in other clips say 10 months of inventory. How the hell are you going to go from 2 months to 10 months? Where are those homes going to come from? This is what happened before prices collapsed. They collapsed between 07 and 08. Well, they collapsed this year, 08. And in 09, this is where that phase came down. But we can see this as investors in the months and years before with the supply of inventory increasing. We can see it right here, and then they had a problem and it crashed out. Then the recovery phase was over here. See how the inventory was getting worked off and coming back down over time? This right here is your tightening of the market. the inventory has to get drawn down. And I'm going to show you an inventory in months of supply. This is zoomed in from December 2019 to December 2020. And you can tell that this is super low. This is why prices are going up. We had 3 months of inventory. It came back up to 5 months. Because remember, this cycles back and forth as well. Typically, you build in the winter months, you build inventory up, and then it works itself off in the springtime and summertime. So we're coming back down, but this time we don't have a build of inventory. In fact, we hardly have any inventory. We only have 1.9 months worth of inventory in December. That right there is nothing in relationship to history. It's an all-time low. So what we're going to see is higher prices. And higher prices are going to turn on the housing starts. This is where the housing starts are going up, and we're going to go into an expansion phase of real estate. Now, I'll kick myself back on here. An expansion phase of real estate is inflationary because you put new loans against new homes that never existed before. And the houses are going up in price. So this is inflationary. That's what it was. Historically, it's been very inflationary, this whole process of an expansion phase of real estate. Now, there's going to be other ramifications, and you've heard me tell this before, is that when house prices go up, it creates inflation. Inflation creates higher interest rates because people want to sell bonds because of the real negative rate. Now, that increasing of interest rates affects other assets, and it spurs an entire rotation of money. So what I see is a bunch of things that are coming up in the future. We know that the inventory has been drawn down. We know that prices are going to go up, and we know that we have to build 4 million more new homes on top of the yearly demand. Inflationary. Now, what we need to look at is what is low. What are the valuations of all the other assets in the world? What is low? We are hoping that commodities are, because commodities are linked to the real estate market, that those cycles are. And the cycle of real estate is about twice, sometimes it's twice as fast, but this time it's not. About a 12-year up, 12-year down, 12-year up, 12-year down for the most recent real estate cycle. And we see that in the commodity super cycle. We've had a down commodities cycle for 12 years. So now what I'm looking at is I'm looking at inventories of commodities. And the commodities, their inventories are getting eaten up. They're going down. And when you look at the market balances, the market balance kind of projects where that deficit is. When you start hitting deficits, it eats through your inventories very quickly. The deficits for a lot of these commodities are coming up. Copper already hit. We're eating through the inventories. Nickel, it's right there. We're eating through inventories. That's why prices are starting to go up already in those commodities. Platinum, silver, it's any second now. I mean, any second. Like, this is the time. This is the last load up period. Even gold. Gold is, their inventory is getting very small. And you can look at the production profiles. You can look at all these things in the future. None of them look that great. Silver going down, platinum going down, gold going down. If we eat through inventory and this hits and we have declining production, oh my God, prices are going to go high. Like, this is not the time to be selling. This is the time to accumulate gold, to accumulate silver, to accumulate platinum, nickel, copper. I mean, this is the time to load up when we know this. Uranium's in the same boat. It's just the deficit is just a little bit in front of us. So what you do, and what I've done as an investor, this is, remember, financial education, is you have to position yourself when the inventory isn't gone yet. Because when the inventory's gone, when you see the inventory gone in real estate, you can't get in because it's gone. Silver is the same way. Platinum, I mean, there's other factors here too. So and I'll explain this in a different clip. This is quite extensive to know the nuts and bolts of all this. And I'll show you the curves. I'll show you the normally distributed curves. I'll show you how a bunch of normally distributed curves add up to create one large, gigantic curve. And as you go up the curve, it becomes harder and harder to extract more and more because ore grades decline. You have to go into more extreme areas. And then you have to also replace the depletion of mines that are depleting, that are on the decline of their normally distributed curve. So it's not just, you can't just exponentially go up and think of it as some easy feat to continue to produce more and more. What you have to do is, it's like carrying something that increases its weight through time. And the reason I'm saying that is, if you have an oil well and you're producing that oil well, you come up and then it'll decline at some point. You have to replace that decline. And a lot of these oil wells, they're smaller findings over time. So you just get these little blips, and there's a buttload of them. And they all add up to the entire production of this bell curve. So you have to produce more and more and more and more and more. But as you produce more, you have to also replace everything that you're losing on the existing production, which could be a 6% decline rate. So then not only do you want to go up 10 million barrels, you also have to replace 6 million barrels from the stuff that fell the previous years, the previous year. And then it declines another 6%, and then another 6%. So each year you have to replace 6 million barrels with new production, and on top of it, increase it with increasing demand. And if you're going and doing commodities, you're hitting commodities that are declining in ore grades, which means you have to move more material to get the same amount of mineral out of the ground, which then, if you have increasing demands, you have to replace the decline rates of old stuff that's being exhausted, bring on new stuff, and then bring on even more new stuff to expand the supply of that mineral. So I propose over time, maybe over the next 50 years, 60 years, that we'll probably run into massive shortages of a whole bunch of minerals. That is called, they did a book on it, Limits to Growth. That's called Limits to Growth. So we'll call it, there's a finite amount on this planet. So people are going to have to go somewhere else to get other minerals, or we're going to have to conserve or be more efficient with the material use that is on this planet. But at some point, we're going to run out, not run out completely. What I mean is we're going to hit constraints where we can't produce any more of a certain material, no matter how much you throw at it. Does not matter. The more all technology does is increase the depletion rates. So you can produce higher for a little bit longer, and then it depletes way fast. At least in oil and some of these other, especially in oil and natural gas. So it's going to hit in any material, and that's why I'm a big proponent of looking at materials. Looking at materials and saying, what is the value of this material to society? And if there's a very large value, like silver, like platinum, and we can hold it physically, those are the ones you really want to hold physically. Because at some point, everyone's going to run out. They're all going to run at it, which we're doing right now. And then they're going to say, well, this stuff's super rare. Then you're going to have all the industrial users run at it. You're going to have countries run at it. They're going to consider it strategic materials. And then they're going to say, you know what? I don't think we should sell this stuff on the market anymore. We're going to nationalize it and say it's a strategic material for our country. And if you hold it physically in your possession, I don't care. You just raise the price even more. I own this stuff in mass quantities. That's why I hold it, because I've thought through this process of what it could potentially look like for hoarding, basically. And I got mine when it was the cheapest it could ever be on a ratio basis to all the other assets in the world. So housing, I don't see the weakness in housing. I see massive strength because of home prices going up, days on the market going down, and inventory being depleted. I'm seeing positive factors and developments in the housing starts, which means we are strong like bull, fast like cheetah in that phase. We call it the Bolita. And we're seeing this across all the commodities, and they're about to come in the next few years. Me and you, are positioning before the big money comes. And what happens is when they see the shortages or the inventory starts get eaten up, they buy it all at the last second. And then they hold that inventory, like copper, nickel, whatever it may be. And the hedge funds and institutional investors, they all just pile in, and it makes the whole thing worse. And then you see these gigantic vertical increases like you see in copper. If you guys like this content, leave comments below. Let me know what you think of this. Did it help you understand how markets work in terms of commodity type markets? If you haven't subscribed to the channel, what are you waiting for? Click the subscribe button. I don't know where it's at. It's somewhere over there, but click that thing. Give me a thumbs up. It helps the algorithms. I'm giving you guys this content. I'm basically offloading what I know about markets to you guys. I'm sure you're using this information. You're making a bunch of money. If you want to donate to the channel, I put it in below in the description link. It's also another donate button. I don't know how you guys see it on my webpage. It's through PayPal. And if you guys need any other help with anything, leave it in the comment section. I can answer these things. I've done so much research, it's ridiculous. And I'll release another clip on what a bell curve looks like, what the decline on energy is for energy return on energy invested. I'll paint you a picture so clear that you'll be like, I gotta own some physical precious metals. I mean, really, I'll paint this picture. Thank you for listening. I appreciate it. And this is Finding Value.